If you are thinking about refinancing and don't know which one and what to do, then this video is for you. There are several types of mortgage refinancing out there, and lenders actually offer so many different things. Okay, and the reason why they offer this is because there are so many people out there with different reasons why they want to refinance, so they want to make sure they're giving you the best that fits your need. So in today's video, we are going to be breaking down what are the major types of refinancing, mortgage refinancing, which ones will save you money the best, when refinancing doesn't make sense, and how to choose the right options for yourself. So by the end of this video, you should be able to know or actually understand which one will fit you and how to go about it, whether it's you lowering your interest rate, shortening your loan term, or even just trying to pull out cash from your equity. All right, so let's dive in. So the number one thing we're going to be talking about today is going to be what is refinancing all about, right? We cannot talk about the different types of refinancing without actually touch basing on what is refinancing. So refinancing basically means you are actually trying to replace an old mortgage with a new one. Okay, and keep in mind that whenever you get this new mortgage, is going to be paying off the old mortgage. All right, so that means that new loan you are taking will pay off your old lender. So let's take, for example, you are actually going in there to refinance, but you are actually not going to use your current lender. That means whoever is going to be giving you the new mortgage, which is going to be refinancing, is going to be your new lender. So that new lender will definitely have to pay off your old lender for you to start the process all over. Okay, and like I said, you could just want to cash out money. Some people just might want to lower their rates, and some people might just want a shorter loan term. So it all depends on you. Okay, so without taking much of your time, let's start on what are the real main types. So there are four main types of mortgage refinancing, and let's talk about the first one, which is going to be the rate and term refinancing. From the rate and term refinancing, you can actually explain it just by what the name goes by, right? So a rate and term refinancing lets you either lower your rate or your term, okay, without taking out extra cash. So you are going to be able to either lower your interest rate. Let's say, for instance, your current interest rate is about 7%, and the interest rate has been going down gradually, and let's just say even if it's just a percentage more. So let's just say, for example, you have a 7% interest rate, and now the interest rate has gone down to about 6%, and you want to refinance. Your main goal, remember, is to lower your interest rate. So can you do it? Absolutely, you could, because at least there's a little bit of difference between the exchange rate, so the interest rate, so it's way understandable for you to lower your interest rate. So on the other hand, if you just want a shorter loan term, let's say you currently have a 30-year mortgage and you want to lower it from that 30-year mortgage to 15 years. That way you will be able to pay quicker and faster. Can you do it? Absolutely. So you can still equally just choose to do the rate and term refinance so that you can lower this duration in which you're going to be paying off your loan. Okay, so what are the reasons why some people would choose to do a rate and term refinance? The first thing is to be able to lower their interest rate to make sure they are saving. The second is going to be able to shorten their loan term, like I just said, from 30 to 15 years, okay, to be able to pay it faster. And the third thing is going to be, some people have what is called an adjustable rate mortgage, so they might want to refinance so that they can move from an adjustable rate mortgage to what is fixed, right? A fixed rate mortgage, you know that I'm only going to be paying this interest rate for this number of years. When it comes to adjustable, it's not going to be the same. Your interest rate might change as time goes on. Okay, so some people want to know that I am going to only be paying for this particular interest rate for the rest of the years, so they might choose to. And moreover, a fixed rate interest is way stable than an adjustable, because like I said, it changes over time. So some people don't want that. Okay, so let's say for example, you go out there, you already have a 300,000 mortgage, like I said, and currently at a 7%, right? And you say, well, this interest rates have been dropping and currently is 6%, and I would really like to refinance. If you refinance at that rate, you might be able to save about $200 a month. Okay, so imagine if you switch from a 7% to a 6%, the same amount of house, right? Was just giving an example, or 300,000, you're going to be saving about $200 a month. So that's gonna be a lot of thousands as the years goes by. Like before you finish paying off, you're going to be able to save a lot of money. Okay, so calculate that 200 times 12 months times 30 years, so it's gonna be a lot of money that you're going to be saving. So that's one reason why people will choose to actually go there to do a refinance. Now let's discuss what could be the advantages and disadvantages of this rate and term refinance. So the advantage number one is going to be you will usually have lower interest rates. Okay, so there are going to be lower interest rate available for you to be able to do this refinancing, and you can actually build your equity faster, and you can equally save on long-term interest. Remember, it depends on how long you're going to be doing this. Okay, if you switch from a 30 years to a 15 years, you're going to be actually saving on interest. That's absolutely correct. So the disadvantages are going to be you're going to be paying closing costs again. So keep in mind that every time you do a refinancing, you are going to be paying closing costs. It doesn't matter how little is it, you are going to be paying for it. Okay, so keep that in mind. It's almost like you are doing a brand new mortgage, so you are definitely going to pay for this. So before you go out there to go and say, oh, I want to refinance, remember that you're paying closing costs. Okay, and the second point is, if you extend your term, you could pay more interest over time than expected. So how would you get into this bracket of if you extend your term? So let's say you already have a 30-year and then you go back, refinance for another 30 years. That's extending your term. Remember that you already have this year, that first mortgage, you paid it off for about 5 years. Okay, and now you go and refinance that mortgage for another 30 years. Those 5 years that you already paid for, they're not going to count inside that new 30 years that you're beginning. So that's why you may end up paying for a lot more in interest rate, even if your monthly payments are going to go down. So make sure you always calculate your break-even point before you step out there to refinance, to know how many months it's going to take you to regain that money you're going to be spending in closing costs for refinancing. Okay, number 2 point, which is going to be the second type of mortgage refinancing, is what is called the cash out refinancing. What is cash out refinancing? Cash out refinancing is mostly for those homeowners who have already built equity. So if you already got a house and you build equity over the years, and you say, I really need some money for investments, for other things, right? Then could my house give me this money? Absolutely. So you can use what is called the cash out refinance. Okay, so they let you take more than you owe. So the lender is going to let you take more than you owe and keep the difference in cash. So you refinance for more than you owe, and whatever is the cash difference, you can keep that minus the total cost of refinancing that you're going to be paying during that process. So let's give an example here. Let's say you currently have a home which is worth 400,000 and you are currently owing on that house for 250. Okay, you could be able to refinance for about 320. The reason why it's going to be around 320 is because, remember, the lender will only allow you to cash out 80% of your equity, so you cannot cash out more than 80%. So that's why you're only going to be refinancing about 320. So take that 320 minus 250 that you currently owe, is going to be giving you something like 700, okay, $70, sorry, 70,000. So imagine if you have 70,000 in hand, but like I said, minus your total cost of refinancing. So the 70,000 minus whatever they're going to be charging you on your refinancing, okay? So that's what you might be walking away when you do a cash out refinance. All right. And what could you use this money for? You could use this money to build a business. You can use this money for home improvement. You can use this money for debt cancellation, okay, or even debt consolidation, whatever, pay off your debts, okay? You can use it for educational purposes. So when it comes to home renovations, stuff like maybe you want to do some bathroom upgrades, some kitchen upgrades, some nice, house, anything that is going to improve and increase the value of your house, okay, something like that. So what are the advantages and disadvantages of a cash out refinance? Well, let's talk about the advantages first. So the number one advantage is going to be access to low cost funding compared to your credit cards or personal loans that normally have a high interest rate. Remember, most mortgages are secure loans, so their interest rates are way lower than what you're going to be having on your credit card, which is somewhere from 20% and above, okay? And personal loans could be higher than your mortgages as well. So number two, you can consolidate high interest debt, okay? And number three, you will be able to build a long-term value if you renovate your house. Like I said, stuff like your bedroom upgrades, your kitchen upgrades, anything that is going to give your house more value, okay? Now, what are the disadvantages? The first disadvantage you should know is you're going to have a high loan balance. Reason being, you took off money off your house, okay? So you took out equity and you have increased debt, all right? Number two, high closing costs. You're going to be paying way higher, okay, as you take out cash from your equity. Number three, if your home value drops, you could be at risk of losing your equity. So please, I don't know, most of the time you really can't predict what is going to be happening in the next few years and all that, but before you go out to do a cash out refinance, please make sure you look at the market trend and make sure that even if I take it out, this house value is not going to drop in the next few months, in the next few years. You know what I'm saying, right? So please do not take out cash refinance to do things that are not going to build value. If you know that you just want to spend money, please keep that equity and don't use it, because you don't want to go do what you're not going to have any return on investment. If you use this money for educational purposes, when by the time you graduate you're going to have more money when you are working, definitely you're going to have return on investment. If you start a business, you're going to have more money when you make those sales and get you're going to get more high return on investments. You can easily pay back that equity that you just took. But if you know you just want to spend vacation, is it wrong? No. But should you put your home at risk to take out equity just to go spend money on stuff that are not going to give you any return in investment? So ask yourself that question. All right, do not use your equity as an ATM. Use it for investments. Number three type of mortgage here is going to be mortgage refinancing is going to be what is called the Streamline refinancing. So come closer, my VA people and my FHA people, this is for you. If you know you have FHA and VA, or VA, there are two different types of loans, okay? There's a VA loan and there's what is called FHA loan, and all these are backed by the government. So if you have any of these, okay, then you can qualify for what is called the Streamline refinance. It's mostly offered to these people, these two categories, okay? And for them it's very fast, simple, and the process out there is easier than the normal standard refinancing process. So let's talk about those who have FHA. So if you have an FHA and you want to use the Streamline refinancing, remember you have to be an existing FHA owner. So you must make sure that you have an FHA loan already in place, okay? And it's only for those who have FHA. It's not for those who have conventional. So conventional people, this don't apply to you. For them, you don't really need to have a lot of documentation. They have minimal documentations and minimal credit checks, okay? It may require appraiser, may or may not, depending on who the lender is going to be, and it can lower your interest rate and your payments. So if you're able to lower your interest rate, you can actually lower your payments as well. For VA loan, those my veterans, those who serve us very well, thank you for all you do. So if you have already a VA loan and you are looking to refinance and you're just wondering, how can I do it quick, simple and easy, okay? Then you can do what is called the Streamline refinancing. So if you already have, like I said, an existing VA loan, okay, no income or appraisals in most cases, typically just a quick rate reduction. So it's easier for them that want to just reduce their interest rates on their house. So if you just want to reduce your interest rate, you could be using this option. All right, so these programs help borrowers save, okay? So it helps borrowers save money easily without them going through the underwriting process of the standard refinance, okay? So what are the advantages of a Streamline? Number one is less paperwork, 2, faster approval, and 3, reduced fee. When we talk about the disadvantages, what are some? No cash out. So except for small amounts of fees, you're not going to be doing a cash out, because this is mostly for those who just want to reduce their rates or lower their payment. Are there other ways you can actually do a cash out as an FHA? Yes, but this particular one, Streamline, won't let you, okay? Number 2, must already have a government backed loan. Like I said, VAs and FHAs are government backed loans, so you need to know that when you go in there. And number 3, you're still gonna pay for closing costs. So yeah, it looks like it doesn't matter what kind of refinancing you do, you're still gonna actually end up paying for closing costs. So keep that in mind. So it's only ideal for those who want to lower their interest rates and those who want to stay in their home long term. If you're not going to stay in that home, if you're going to be selling your home in a couple of years, couple of months, don't worry about refinancing your house, okay? The number 4 type of refinance is what is called the specialty refinancing option. So it's called specialty because there are so many different cases out there that might not fall under the cash out, the Streamline, the rate and term, right? They have specific situations that they want to address. So that's why it's called the specialty option. So under the specialty options, there are some amazing points that we're going to be talking about, and the first point is what is called the cash in refinance. Remember, I talked about the cash out refinance, so let's talk about the cash in. From the name, you can actually tell what it is, right? If the cash out is you pulling out, cash in means you're actually going to be putting in money, so it's the opposite of cash out. So when it comes to cash in refinancing, you actually bring money to the closing table to reduce your balance or lower your LTV. So it's useful for those whose mortgages are already underwater, or they just want to eliminate what is called the PMI. All right, so if you have money sitting somewhere and you know that your mortgage is a little shaky, and you just want to be able to take out PMI from your mortgage, because that PMI could be costing you a little more higher, okay? So if you're able to take out your PMI, why not? You can still do a cash in refinance. But like I will always say, if you have conventional, why not just pay more money so that your PMI can drop off quickly, rather than going to refinance to pay more money? Because remember, every time you refinance, you pay for closing costs, okay? The second point on that specialty is the short refinance. So short refinance is offered by lenders to help struggling borrowers. So if you're out there struggling on your mortgage, you could ask your lender or someone else if they are offering short refinances. Okay, so they offer this to borrowers that are struggling and they are at the point of foreclosure, so they can be able to avoid foreclosures on their houses, and the lender might agree to forgive part of your balance, whatever you're still owing, and issue a smaller loan. So if you find yourself in this situation, you could go out there looking for whoever is willing to give you what is called a short refinance. Number 3 is going to be consolidation refinance. A consolidation refinance, for those who have maybe a first and a second mortgage, you can be able to combine, okay, your first and second mortgage, like a home equity line, into one loan. So it will give you a simplified payment and you can lower your blended interest rate. Okay, so like I said, you can always seek from your current lender, or you can ask from someone else. Another, there are so many lenders out there who are ready and willing to help. Okay, so just do your research. And number 4 is what is called the reverse mortgage. The reverse mortgage is for those our elders, our parents, our fathers and mothers up there who are 62 and above. So if you have any family member that is 62 and above and currently have a mortgage and is thinking of refinancing, you could tell them, hey, maybe you want to do something called a reverse mortgage. So what is a reverse mortgage? It lets you convert part of your equity into income, okay, with no monthly payment. And remember, you or your heirs are going to pay back when the house is sold. So it's not forever, okay? You're still going to pay them back, but not just at the moment if you are 62 and above. So whenever you or whoever is going to be inheriting the house sells the house, they are going to pay the money, all right? So keep that in mind. There's nothing free, okay? So if you are out there trying to refinance and you want to ask yourself, oh, what type of refinance is going to work with my goals, then there are you to understand that. So the next point we're going to be discussing is how to choose the right mortgage type. So how can you actually tell what your right mortgage type is going to be? The first thing you need to do is know what your goal is, okay? So we're going to be talking on some goals and what could be the best possible option for you if that goal sounds like what you're going to be doing in the future. All right, so goal number 1 is, if you just want to lower your monthly payment, what is the best option you could be using? You could use Streamline or rate and term. Remember, Streamline is for those who have VA and those who have FHA, but those who have conventional could be using what is called the rate and term, okay, if you just want to lower your monthly payment. The second goal is if you want to pay up faster. If you want to pay up faster, your best possible option could be rate and term or short-term refinancing, okay? Number 3 is if you just want to access cash. Yeah, if you want some cash out of your equity, then you go with what is called the cash out refinancing. Number 4, if you just want a simplified or combined loan, then think about consolidation refinancing. Number 5, if you think about, I just want to build my equity faster, why not go for a cash in refinance? And the last point for this is going to be if you just want to fix your financial hardship. If you're really having hardship and you're struggling with your mortgage and you want to refinance, what could be the best possible option out there for you? It could be what is called a short refinance, okay? So from the videos, the points and the different types of refinancing I explained, then you can understand properly why these options are going to be almost the best for you if your goal falls into any of those categories, okay? I mean, there are different people out there, so and they have different goals. If you have more than one goal at a time, don't worry, your lender is going to walk you through. You can actually ask a mortgage advisor. You can equally read the books out there. So make sure you do your own research, okay? Don't just go by what I say. Do your research, ask questions, and ask maybe even your agent. Ask those who are going to be helping you through the process. They know better, so they are going to be directing you on what to do and what not to do, okay? But first, make sure you start by identifying your goal before you choose the best option, not the other way around. Don't go choosing the option before you figure out, oh, what is my goal really going to be looking like. You cannot try to reduce your loan and then want to go out there and choose a cash out refinance, okay? So don't go say, I want to do a cash out refinance before you remember your goal wasn't even going to take out the equity. Your goal was for you to be able to reduce your loan term, all right? So remember that refinancing is one of the most amazing and powerful tools out there for homeowners to be able to build financial stability and long-term saving, but only when you choose the right type and only when you do it right, okay? So let's take some time to do a quick recap on what we just said. Before you go out there, make sure you compare your current rate on term. Run your numbers at all time before you refinance, including any closing costs or anything that you're going to be paying. Know your goals before you go out there to apply. If you found this video helpful, please click the like button, share, turn on your notification bell as well, and subscribe to my channel if you have not done so, so you will be the first to know whenever I put out these amazing tips for we that are trying to refinance or learn anything about real estate and finance. As always, thank you so much for watching to the end of my video. Remember, my videos are for educational purposes only. Do your own research and ask those people out there, the lenders, the mortgage advisors, the lawyers that are going to be helping you, even those who are going to be helping you file your taxes, okay? They can have some of these answers for you, and you can equally read, okay? Do your own research. There are so many nice websites, so many books out there that can explain these things to you, all right? Thank you for watching to the end. I stay safe and healthy until next time.